when the credit bubble bursts, which it's pretty much in the process of doing. I mean, it will be once we get the next rise in interest rates, next rise in bond yields in particular. Whatever the Fed does with the interest rates is a slightly separate thing. But bond yields, when you see the 10-year Treasury going up and beginning to look like it's going to go through the 5% yield level, this is going to kill equities. Currency problems are going to be continuing, and I think they are probably still mounting. And under those circumstances, I really can't see any meaningful selling of gold or silver. And I would have thought that, if anything, gold and silver represent really pretty good bolt holes for those getting out of these risky currencies.
The dollar continues to weaken against major currencies such as the euro and the Swiss franc, as markets digest the implications of a ballooning U.S. government deficit and the uncertain outcomes of ongoing trade negotiations. According to author Alasdair Macleod, since President Trump's Liberation Day speech in April, the dollar has dropped by more than 10%. He points out that unless investors have been concentrated in the top-performing tech stocks, such as the so-called Magnificent Seven, they've likely seen a net loss in purchasing power. What makes the dollar's recent slide particularly concerning is that it's happening alongside rising U.S. interest rates, an uncommon divergence. Typically, higher rates attract capital and strengthen a currency, but this time the opposite has occurred. Macleod notes this resembles the UK's late 2022 market behavior, when a fiscal credibility crisis sent the British pound tumbling. He warns that a similar risk premium may now be emerging around the dollar. This dynamic is not limited to the United States. Macleod observes that other currencies, including the Japanese yen, are starting to show signs of strain. Even the British pound could come under pressure, especially considering London's prominence as a global financial center. In contrast, gold continues to shine amid rising volatility and waning confidence in fiat currencies. The metal has gained over 25% since the start of 2025, driven by persistent concerns about inflation and growing economic uncertainty. Though gold remains range-bound in the short term, analysts note that a weaker dollar is helping to maintain its upward bias. Macleod argues that with currency risk spreading globally, gold and silver offer safer alternatives for preserving value. That sentiment is gaining traction in the U.S., where Texas recently passed a landmark law recognizing gold and silver as legal tender. Signed by Governor Greg Abbott on June 29, 2025. The legislation allows Texans to use precious metals in everyday transactions. This development is stirring conversation across financial circles and signals a growing interest in returning to sound money principles. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, I don't think there's ever really been a frothy top. I mean, there was a very brief moment when you could say that silver was a frothy top, got up to what, sort of 37-ish, something like that. I mean, but really the reaction has been very, very minor from that frothy top. And the same with gold. I mean, gold sort of spiked up early one morning to 3,500, but I think it's just been moving sideways. And in these, as I was saying earlier, in these very quiet trading conditions, you would expect it to drift lower. I mean, I talk, if you like, as an ex-stockbroker. And, I knew that in the case of any stock, and it's the same has got to be true of commodities, in the absence of buyers, prices go down. Now, here we are with gold, close to all-time highs. You've got no interest in the market. I mean, really very little in retail interest, that is for sure, because everybody's just out there enjoying the weather. Or, and this is what I found as a stockbroker in the UK, I mean, it was so frustrating, the summer months, because there was I on the floor of the stock exchange or in my office trying to contact clients to find that my competitors had taken them out to Ascot, Henley, all the sporting facilities. I couldn't get onto anyone and get them to deal because they were already being, wined and dined by my competitors. So, it's the same thing now. Nobody's interested. And you would think gold and silver would drift off, but no, they're not. I think part of the reason is the weakness in the dollar. I mean, I think you've got to look at the dollar from the foreigner's point of view, always. They own, in terms of dollars and underlying financial assets, including about, I suppose, 7.5 to 8, or no, it's about 7 trillion of bank deposits, figure like that. Total is just under 40 trillion, of which I think about 14.5 is in equities. I mean, this is a lot of stuff to be sitting on when the dollar's going down. And the dollar from President Trump's sort of if you like, Liberation Day on April the 2nd, dollars lost well over 10%. So where have you made up the currency loss on your underlying investments? Well, the answer is you basically haven't. You might have done a little bit, I suppose, if you'd sort of continued to invest in Nasdaq type stocks, the Magnificent Seven, because they perform reasonably well. But you're buying into hot air. I mean, come on. It's the idea that these stocks are value, if you like, that's just nonsense. If I was a foreigner, I would be, I'd really be reducing my positions, particularly when you get President Trump turning around and saying, the dollar should be lower. Okay, well, if it's going to go lower, that's not going to do me any good. And also President Trump turning around and slagging off Jay Powell. I mean, you begin to think, well, who's running things here? Right? Slagging off Jay Powell is actually a very bad thing to do. I'm not saying that I think Jay Powell is necessarily the most wonderful human on the planet. But, if you want stability in a currency, the last thing you do is start slagging off the guy who's actually running the most important institution, providing that stability. He's doing the job to the best of his ability. And I would say he's actually been doing quite a good job, given if you like, the misconceptions that are around, Fed economists, because he's got to reflect the consensus, I guess. But I think he has actually been doing quite a good job. And to have a president turning around and saying, I'm going to sack this man as soon as I can and all the rest of it. If I'm a foreigner owning dollars, I don't think I want to own dollars anymore. And the point is there's 40 trillion of these dollars held by foreigners like me. Why hold them? And particularly, I mean, if you're, let's say, a trading business as opposed to an investor, you hold dollars for international liquidity. I mean, you've got to go out and you've got to buy commodities and all the rest of it, and you get payments, and you're going to end up with some liquidity. You've got to have liquidity. But now that the global economy is turning down, and even though governments aren't admitting it, you probably see it in your own trade, seeing what's going on with shipping and all the rest of it. You got too many dollars. Sell them. It doesn't make any sense holding on to them. The problem is, what do you sell them for? Well, if you're a foreigner, and let's say you're, say a German manufacturer like BMW or Mercedes or someone like that, then you account in euros. So anything out of euros becomes, if you like, a risk, a profit risk. But basically, you've got to sell your foreign currencies and go back into euros, and that basically, I think, is what the dollar is suffering from at the moment. Particularly euros, yen also, but I think probably to a slightly lesser extent than euros, selling sterling for exactly the same reason, because sterling is overowned, and it's overowned because London is the international financial center in the European time zone. Banks, institutions, and all the rest of it have sterling, and I can't see for the life of me why they should. So that, I think, currency problems are going to be continuing, and I think they are probably still mounting, and under those circumstances, I really can't see any meaningful selling of gold or silver. And I would have thought that, if anything, gold and silver represent really pretty good bolt holes for those getting out of these risky currencies.
Alasdair Macleod warns that as interest rates and bond yields rise again, the tech sector is likely to come under pressure, and Bitcoin may suffer even more severe consequences. He describes Bitcoin as a speculative asset, a modern-day version of historical manias such as the South Sea bubble of the 1700s. The odds of a Federal Reserve rate cut at its upcoming July 28th and 29th meeting have decreased following the release of a stronger-than-expected June jobs report, which alleviated concerns about an economic slowdown. According to the CME FedWatch tool, the probability of a rate cut dropped from nearly 25% to just 5% in a single day. This shift in expectations reinforces the case for sustained higher interest rates, which could challenge riskier assets such as tech stocks and cryptocurrencies. Macleod draws a clear distinction between Bitcoin and gold, urging investors to reflect on the true definition of money. He argues that real money must be stable, trustworthy, and creditworthy. If an asset fails to meet those criteria, it's not money, it's a gamble. From that perspective, Bitcoin, he says, is ultimately likely to evaporate. A recent technical development further illustrates the divergence between gold and Bitcoin. The Bitcoin to gold ratio has formed a double top and subsequently declined, suggesting that gold is regaining its dominance as a store of value. After testing its 2017 highs, the ratio failed to break higher, reinforcing resistance and indicating that gold is outperforming. Let's get back to the interview.
I mean, the story, obviously, with Bitcoin is that it's, it's tomorrow's money or something. The point about my article is that it can't actually be money. A lot of the hodlers assume that you're going to get a complete collapse of fiat currencies. And under those circumstances, then, Bitcoin is going to be useful. But, there are two things that go against that. Firstly, governments don't collapse with their currencies. They may change, but they don't collapse. And their response basically is that as ever any threat from the private sector, they will jump on it. And here we have a private sector currency looking to supplant national currencies, government paper, government credit. They're not going to permit it. Governments will change. Of course they will. But they will basically get more oppressive. And I think the idea that any challenge to them, they're going to jump on it. We even run this risk with gold. I mean, the difference is that gold is legal tender. It is legally money in all our laws. Bitcoin isn't. So I think that's the first thing. The second thing is that they assume that in this sort of anarchical, this system of complete collapse, there's going to be electricity to continue to for you to be able to charge your phone so that you can use them, if you like, for transactions and all the rest of it. That's not going to happen either. Hopefully we don't have those conditions, but you can see that as a currency replacing current government credit in the form of their currencies, this actually is impractical from that point of view. The other point I was making is that I think that people who are promoting Bitcoin as the future of money don't actually understand the difference between money and credit. The whole way in which money and credit relate to each other is that you don't actually spend money. That sits in the background. Credit is what you spend. Credit is what is created on demand and is actually used in business and by consumers. Credit in the form of currencies, credit in the form of bank deposits, whatever. All that is credit. You need to tie that credit in terms of its value to money. And that is the whole point that we had in the past about gold standards. The point about a gold standard is that it is something which doesn't fluctuate. In terms of its purchasing power, it is relatively constant over long periods of time. Only if you have that can you have credit which is useful in the economy, credit circulating in the economy, so that businessmen, for example, can work out, the profitability of a venture over time, and if they've got to borrow money, they know what they've got to repay in terms of value of what they produce and all the rest of it. This is the whole point. You don't actually go out and spend gold coins. It is the credit which is tied to it, which actually is the circulating. That is the important point. Bitcoin cannot do this. Who on earth could possibly take out credit based on Bitcoin for any purpose whatsoever? For the very simple reason that you have no knowledge as to what the value of that is going to be, let's say after a year or 2 years or 3 years of a project. You can't even calculate what the project is going to produce for you. In other words, the idea of Bitcoin is it only works if there is no credit attached to it whatsoever. Then what you're doing is you're collapsing the economy. You're collapsing the economy so that it'll never recover to what we now know, and you're effectively going back to medieval times. It just doesn't work. It's as simple as that. So therefore, what is Bitcoin? Bitcoin is, it's interesting because in my article, I show how it correlates with NASDAQ. And also I found that CNBC does a MAG 7 index, And, it correlates absolutely beautifully with that. When the Mag 7 are up, Bitcoin are up. When the Mag 7 are down, Bitcoin are down. I mean, this is, if you like, a tech stock, which, with no trading risk, no business risk at all, but no assets and no profits. It's just a piece of, something in midair. And what this means is that if it correlates with, these very, very highly valued tech stocks, when the credit bubble bursts, it's pretty much in the process of doing. I mean, it will be once we get the next rise in interest rates, next rise in bond yields in particular. Whatever the Fed does with the interest rates is a slightly separate thing, but bond yields, when you see the 10-year Treasury going up and beginning to look like it's going to go through the 5% yield level, this is going to kill equities, and it'll particularly kill the high flyers. I mean, we found this last time when NASDAQ collapsed. I can't remember whether it was in the year 2000. It certainly collapsed then, but also, I think particularly then. I mean, it lost something like 78% of its value after the dot-com bubble. So what's that going to do to Bitcoin? Bitcoin is just, what are these things with, or one of these Mag 7 pretending to be a Mag 7 when it's not actually anything at all. Anyway, that I think is the conclusion of my researches into it. The madness of crowds sort of thing, where you get a real previous expansion of credit and matching debt. A lot of this goes into speculation. And this is just so much like previous, bubbles. It really is. And I think there was one company which, at the time of the South Sea bubble, here we're talking about 1720, was floated and actually raised money on the basis that, and its prospectus said that nobody is to know what the company will do, and it raised money on the basis of that. And I remember seeing something similar in the year 2000. We're there this time with Bitcoin. So this is not good news for hodlers. And for those who sort of can't really make up their mind whether they should be holding gold or cryptos or whatever. I mean, look, just think it through, for goodness sake. This is, understand it. Understand what money is. It cannot operate as money. It just cannot. If it cannot operate as money, then what is it? It's nothing. It's a volatile bomb. It's going to just go puff.
Confidence in fiat systems is showing visible fractures, and with rate hikes no longer defending the dollar's stature, traditional relationships between currency, debt, and capital flows appear to be unraveling. The growing appeal of gold, and even legislative shifts in favor of tangible money, meanwhile, risk-laden assets that once thrived on low-rate euphoria now stand exposed. As financial norms shift beneath the surface, the spotlight returns to assets with permanence. Could we be witnessing the early signs of a transition from digital speculation to tangible preservation? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.